Good evening, everyone. Excited to have you guys on tonight. I'm excited about the topic, exactly why 2026 is really the perfect time to invest in real estate. I want to make you a promise, right? This presentation is not to get you excited. It shouldn't be about convincing you why 2026 is going to be easy or that you need to rush into anything right this second. What I want to show you is why right now, why this moment today, this season, this year represents kind of one of the most strategic windows that we've seen in years. And that window is for really thinking about building real generational wealth and thinking about that through real estate investing. And I want to prove it to you with data, but I also want to look at history. So look back in order to help us make the decision today. And I want to use kind of real life examples that exemplify everything that I'm talking about. So stay put, get excited. Again, feel free to ask any questions, put it in the chat, and I'll get to it. But before we jump in, right, I want to take a moment to just address something that's really important. As accomplished professionals, you understand the value of thorough due diligence. So the information that I'm sharing with you today, right, it is for you, but I want you to kind of take this opportunity and review it with your trusted advisors because that's what savvy investors do. But after that, strap in, let's get ready, and yeah, let's get ready. So I want to start with a story, and I've through the years of investing in real estate, right, I have had conversations with a lot of investors, a lot of healthcare professionals, a lot of physician investors. And I spoke with a physician investor a few years ago, a super brilliant guy, but I noticed that he was very cautious. He was analytical. He had been watching kind of the real estate market maybe since like 2018, 2019. But every year, right, he found a reason to wait. So he said the rates, then COVID happened, and then all the prices corrected, and then inflation started happening at a more rapid rate. And then, you know what happened? By the time things finally kind of cleared up a little bit, the opportunity that he had been waiting for was gone. At that point, prices were higher, competition was fiercer as expected, and things changed, right? But nothing really went wrong, and that was the problem, right? He was just kind of waiting for certainty, for clarity, and sometimes that certainty only arrived after the opportunity kind of had passed. And that's the trap with some of us, like professionals or high income professionals. That's something that we fall into. So it's not bad decision, but it's actually not making a decision in the first place. And that's a little bit about why I want to educate you, about looking through the past and then helping us to make decisions today. So after, the 2008 market, right, real estate it felt broken, right? Banks were failing. The media was kind of like apocalyptic. People were convinced that the entire system had collapsed. And yet somehow between like 2009 and 2012, right, some of the most extraordinary wealth in real estate was created. That period where things didn't feel great, things were shaky, where there was a lot of uncertainty. And the truth is that the people who bought during that window, they weren't the most confident, right? They weren't celebrating. They were often scared or terrified, right? But they moved anyways because they understood something that is very critical and something that's very fundamental. And that's that the actual fundamentals matter more than the feelings. And so, like, even if they felt scared, even if they were uncertain, right? They understood the fundamentals about real estate. And so they went in and they dove in. And that was so helpful for them. And so, even though today's market is not exactly like 2009, the psychology feels kind of like eerily the same, right? And that's exactly what I want you to pay attention to right now. And I would say that like the kind of the last 3 years forced a reset that honestly we needed in the market, right? Prices corrected, they became more realistic. Underwriting, so kind of the assumptions that we made in every deal in real estate, those underwriting standards, they tightened a little bit because they had to. And operators who were taking shortcuts, right, who didn't know, they either adapted and they understood what was going on in the market or they left the market entirely, right? And then there's something also happened in kind of the last 3 years. or in the last maybe 12 months, oversupply has corrected. So in the last kind of like 3 to 4 years, there's significant oversupply. And in the last 12 months, that has corrected, and we'll continue to see that. So the amount of new product, new housing coming to the market has um, slowly been receding, and so we're at a place that supply is now almost matching demand. So you guys, what we have now is really feels like a much healthier environment. So the people are, investors are actively deploying capital, but they're doing it, they're not chasing the headlines, right? The people who are thinking, okay, I'm ready to invest now, but they're, again, right, they're doing what happened in 2008, 2009. They're building these portfolios with fundamentals. And some of the smartest investors I know, like, they didn't stop investing during this period. So they're not sitting at the sidelines. And that's why 2026 is kind of crucial, right? It's not going to be a huge boom. And I'm going to talk about that, right? It's the people who understood, who studied, who are sitting on the sidelines, and who are saying, I'm not going to continue to sit on the sidelines during this period. I'm going to be strategically investing, strategically purchasing. Now, these people, right, what they did is that they slowed down again, right? They sharpened their pencils, but they also sharpened the criteria at which they're willing to invest. They have money sitting ready to go, right? So now with the fundamentals correct, the education, right? They found themselves that they're positioning themselves to be able to invest when everyone else is afraid, everyone else is uncertain, everyone else doesn't know, almost feels like everyone else is paralyzed. They're still moving, they're still investing, they're still buying. And that is what strategic investing looks like. And that's what we need to position ourselves for in 2026. So the best advice that I can give you, right, if you're sitting here, if you're listening, if you're, joining on one of our live streams, is to learn, is to understand the fundamentals, and then to go in and to invest from there. So this is what I hear a lot of, high income professionals, busy professionals talk about, healthcare professionals, right? I'm just waiting for the right time. And I get it, right? I get it because the waiting feels very safe. But I want to show you exactly what that waiting is actually costing you, right? If you're sitting on, let's just say you're sitting on $100,000 in cash and you're waiting for like that perfect moment, right? What ends up happening is that inflation is eroding at like maybe 3 to 4% of that 100,000 every year. And that's costly, right? But the real cost, I don't think it's inflation. It's the compounding that you're missing out on, right? So every year that you wait is a year of cash flow that you didn't collect. It's a year of distributions. It's a year of appreciation that you didn't capture on the real estate property, on the investment. It's also a year of tax benefits that you didn't leverage, right? So it's yes, inflation is terrible, but like all the other things that you're missing is kind of the things that I just talked about: cash flow, the appreciation, the tax benefit. And by the time all of these things, like by the time it feels really good, you're like, okay, I'm ready, right? Again, the opportunity would have slowly moved on, right? The best time to invest, I've told my investors, was 10 years ago or 5 years ago or even yesterday, but the next best time is today. So even if maybe that opportunity has moved, right, it's preparing yourself for the next best one. And I think that the irony when you think about it is that waiting reduces the risk, but it's not true, right? It often actually creates more risk. And I'm going to talk a little bit about that because I want to shed some light and some clarity on that. So 6 years ago, I'll tell you a little bit kind of about my story. 6 years ago, I thought I had figured it out, right? I was an emergency medicine physician and I was making good money. I worked hard. I was responsible, right? I did all the right things. And on paper, if you looked at me and you looked at what I was about, I was by every definition successful. But then things changed at work, right? We saw kind of shift in the practice of medicine, private equity coming in, and everything just started changing, right? Some of the best physicians I'd worked with was slowly let go, hours were cut, and this was reality, right? And people who kind of had dedicated their careers to that hospital, some of them were pushed out because maybe they just didn't fit a spreadsheet or they didn't meet a metric, right? And that's when it hit me. And that's a little bit why I'm here today and kind of how my story has evolved, right? But it hit me that I had zero control. And so despite that success, and despite the income, despite the credentials, I was completely dependent on a system that in any second could change the rules, right? At any moment, things could change. And so that was part of my story. And that truly was my wake up call. You know, I learned that high income really does not define financial security, right? There's more to that. And I'm an example of that. And I understood and I finally learned that like playing it safe, and like keeping everything tied to that one job or my W-2 was actually not safe at all, and was actually a little bit more risky. And so that became kind of the reason why, I ventured into real estate investing. And so I made a decision, and that decision I made was really to think about ownership, right? It needed to be more than just income, but I started thinking about how those income and that asset could produce more income, whether I showed up to work or I didn't. So I'll tell you, right, my first investment was in an apartment complex and I invested 50,000. I didn't know everything, right? But I wanted to learn. And I was learning as I went, I learned more, and I understood the financials, I understood kind of what the capital expenditure meant, all of that I kept understanding, I kept learning. But my first quarterly distribution came about 3 months after the investment closed, and it was $800. And that changed, kind of how I saw the world. It was the first time that I'd ever made money while I was sleeping. Yes, it was a very small amount, right? But that it was more about the shift that I understood, going from kind of earning to owning. That was what that money did for me. And it almost felt like it gave me my life back, right? And today, I still practice medicine because I love emergency medicine. And I really do feel like I'm making a difference. But now it's on my own terms, right? So I can work 8 shifts a month, and because I choose to. It's not because I have to. And that freedom, or that decision to have options, I had the freedom to choose. That came from ownership. That came from starting with that one investment and then growing it substantially. And that's what I want to help you understand today. And that's what I also want for you, as an investor, as someone who's thinking about jumping in, as someone who's thinking about how to lean in. So again, I told you, right, why 2026? But I want to be crystal clear about that. There's nothing magical. This is not a boom year. This is not, 2021 where the prices are soaring and everybody's rushing in. That's not what this feels like. This feels more like a year of positioning. So I want you to pay attention, because motivated sellers exist. So people who bought. So 2021, right? A lot of investors, a lot of people, they bought at peak prices and they bought with floating debt. And now they're facing this harsh reality where debt has kind of stabilized. So we're not in that 2022, 2023 chaos anymore, right? It has peaked and it's now coming down, but it's nowhere close to 2021. And so that's where we are right now, right? Plus, I talked to you a little bit about supply, right? So supply is still constrained, especially in workforce housing. And there's so much demand for rental, right? Because the rental fundamentals are still very strong because people need a place to live. It is that simple. And so there was this period of oversupply in certain regions, but that has again started to recede. What all of this is really creating, and this is where I want you to kind of sit back and understand with me, is that it creates an opportunity where we can now start entering deals with very realistic assumptions, where we can think about the basis and really position ourselves for long-term upside and long-term growth. Now this involves working with operators and partners who really understand the market, and who kind of have a clear picture of where we're going based on the fundamental of what's happening today and what happened 5 years ago. So right, like, so we don't need the perfect conditions. You just need to be ready for kind of the right time where everything's falling into place. So I would think about this as the analogy where, like, there's a lot of traffic, right? And you merge lanes or you change lanes, right? And you go into the lane, and that lane is the lane that starts moving, right? So you position yourself for when traffic starts moving, because real estate is very cyclical, right? It's going to move again. And so it's like, how do I position myself to be at the right place at the right time? And the people who position themselves will be the ones who benefit from it. And so that's why you're sitting here and you're listening and you're saying, why is this the right time, right? Again, it's not a boom year, but it's really kind of positioning and strategy is what's going to help us all succeed. So, what are kind of sophisticated investors doing right now, right? They're not chasing high IRRs, right? They're not asking, what's the next best? Like, where am I looking for 20% or 25%? They're asking, what is the downside if things don't go perfectly, right? And that's the question that I want you to be asking. I want you to really think about, right? The sophisticated investors they're prioritizing cash flow over speculation, right? So you need to be looking at deals that are producing income today, not deals that are going to work if everything goes right. So like perfect, 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 because that never happens. So you're looking at deals right now that are already cash flowing and then figuring out how can you make that better. And then the sophisticated investors are really looking at operators. So really looking at partners, looking at owners who have experience, especially, in uncertain times, because those matter. So you're looking at track records. How have they performed in the last 5 years? Has there been, what has been their success rate? What were failed deals? What did that look like? Because I think it matters more than ever now to see, because that will help you position who you want to partner with in the future. And again, right, we're thinking 5 to 10 year horizons, right? This is the quiet work of building wealth. That's what it looks like. It's thinking through cash flow. It's prioritizing, the owners, the operators who have experience. These things are not making the headlines, right? But it's actually what works. And that's exactly what we're doing at Phoenix Capital. It's making sure that we are prioritizing the right things so that we can all win, so that we can all grow, so that we can all be owners, especially in a market like this. So it's important, and I'm kind of spending some time on this, but I want us to reframe, risk. Like, what does risk mean? Because I think a lot of people misunderstand what risk really means. When people say they're waiting for, the right time to invest, or they're waiting to reduce their risk, what they often mean is that, like, they are avoiding discomfort, right? But I'll say this: risk is not binary. So there is risk in investing, right? You take a risk, it's a calculated risk, you learn, you understand the fundamentals, and then you make a decision. So yes, right, there is risk in investing, but there's also risk in not investing. And that's what I want you to understand today, right? So again, I told you that inflation is eroding your capital. Opportunity cost is compounding against you, and I gave you all the reasons why. And time is passing that you're never going to get back. And as a physician, I learned in the ER, right? Inaction, is just as dangerous as taking the wrong action. So not deciding. And sometimes, right, the riskiest decisions we make is to do nothing at all, is to just like stay put, and not make a decision. I think that's just as dangerous as making the wrong decision. And I'll tell you that I've learned this in some of the hardest ways, but I want you to understand that. So I think the question that you should be asking, or you should be thinking about, that the question isn't, is there risk? Because there is. The question is, which risk am I comfortable making today? That's how you should be thinking in 2026, right? Again, I told you, not doing anything is risky, doing something is risky, but understanding, coming from a place of understanding, a place of clarity, a place of education, understanding the fundamentals is what's going to help you make a better decision. And so I'll say this, right? As we think about what does 2026 mean, how really do we get involved in real estate investing? Over the last 5 years, right? In how I've looked at deals and how I have invested, I have developed a very simple framework, and it's kept me out of terrible deals that looked amazing on paper, but would have been disasters in reality, right? And it's three questions. It's not difficult, but if every deal has to pass these three, or honestly, I'm not investing in it, and we are not investing in it as Phoenix Capital, and our investors are not coming into it. And I don't care, what the projected returns look like. You don't have to sell me 30% if the fundamentals are not there. If I can't base it on these three frameworks, these three questions, then I'm not doing it. And the first one is, does it work today? So it's not, on paper it looks beautiful when you sell like a future scenario. So in 3 years, when the conditions are right, then you'll be able to make that money. That doesn't work, right? it needs to work today. So right now, with the current rents, with the current conditions, does it cash flow? Is the deal going to work today? That is very, very important. And then question two is there downside protection if things don't go perfectly? Because I will tell you from experience, right? Nothing goes according to plan. Nothing goes the way it's, on the spreadsheet, it looks beautiful. And then, when you start, when you purchase the property and when you start running it, right? A fire might happen, something else might happen on the property. Property management might not go according to plan. Just there's everything that you can think of will go wrong, can go wrong, right? So is there downside protection if things don't go perfectly? That is something that I ask every time. And I want to fully understand that that is considered when we are investing in a deal. And the third one is, does this align with life goals? And so, I didn't scale down in medicine, to think about, what else, right? But so part of what that means is this passive, right? For me, that was very important in the beginning, right? So passive cash flowing assets that give me freedom. So those are kind of the three things that I think about from a framework standpoint when I look at deals. And I want to share that with you because especially, I come across a lot of new investors, brand new investors who are thinking, well, how do I get in? What does this look like? I would say when you are discussing with an operator, ask them these questions, right? Tell them to show you what it looks like. Will the deal work today? What are current rents? What the cash flows look like? What is downside protection? Is this truly passive? Show that to me. But when you start approaching deals, right, from that standpoint, it has been a game changer for me and it will be for you too. And I want to show you, so we have a current property and it's called Park at Arlington. And I want to use this framework to kind of help you understand how we really look at deals, how we think about deals. And I definitely want to see if I can apply the same thing to that. Okay, so here's the Park at Arlington. It's 188 units and it's in Covington, Georgia. It's about 30 minutes, 25 to 30 minutes just east of Atlanta. It's on the, I-20 corridor. And we're acquiring it for 33 million. And someone here might think, okay, Georgia, why Georgia? We'll get into that. But I want to tell you exactly why this asset, the market, really represents everything that I've been talking about today, right? This deal, when you look at the numbers, and I will, our team will be able to send that out to you, but like it's not designed to be flashy. It doesn't have the highest projected IRR, right? But it's designed to pass that 3-question framework, which is bigger than those 3 questions, but you have to think about it from a fundamental standpoint. And so that has to be consistent in how we look at deals and exactly what happens in the broader market. So our team is going to put up a link. If this is something that you think you might be interested in or you're ready to go, click on the link. It'll take you to Secure Portal. Just create an account and we will get in touch with you and kind of walk you through the rest of the process. Okay, so again, right, thinking through the fundamentals, this is why Covington matters right now, right? September 2025, Rivian, which is, if you haven't heard of it, it's an electric vehicle manufacturer, EV manufacturer, and they officially broke ground on a $5 billion, that's with a B, $5 billion plant just outside of Covington. This is the largest single development project in Georgia's history, right? From the research that I could do. And when it is fully operational, right, the plant itself will deploy 7,500 direct workers. And then that's just for the plant itself. And then it'll create another, like, I think about 8,000 jobs. And those are indirect jobs, which will come through like suppliers and vendors who are, kind of pouring into that plant. So from research I've done, right, production capacity is going to be about 400,000 vehicles every single year. And construction starts this year, 2026. And for the first set of vehicles are going to roll out, I think, in 2028, so early 2028. But it's not just Rivian, right? Meta is also building a massive data center in the same area, right? And so combined, you're looking at about like over 15,000 jobs, but that's over 5 billion that's flowing into the local economy. Now, I'm telling you this because it's not like maybe, it's not hype. They've already broken ground. Contracts have been signed and like money is starting to be deployed. that looks like in the next, we think, 12 to 24 months, right? We're going to start seeing a lot of that work happen in this region. And as people start coming in, right, to fill this, right, they're going to need a place to live, right? Again, fundamentals. And that's where we come in. But even thinking about this is thinking about future projections. Remember, I told you everything doesn't have to look perfect, it has to work today, right? So this is, I want to break down like housing thesis in very plain English, right? So I told you that when you bring kind of 7,500 workers in the area plus all of Meta, right? Again, they need a place to live. They're not buying $1 million homes, right? A lot of them are renting, and they're looking for quality, housing. And that's where like apartments like the Park at Arlington, that's where we sit and that's where we come in, right? It's quality, safe, well-maintained properties that are priced for people that are earning anywhere from like 65,000 to 80,000 a year. And that's the people that will be working, at the plants, and around there. But this is even what makes it more compelling. Like they're finally, um, we've come to the place where we have limited new supply, right? So in this area, there's not a lot that's being built now, but we still have this massive demand that's coming online in the next, again, I told you like 12 to 24 months. And so you have this constrained supply. And so now we're able to absorb it. That's what fundamentally strong looks like as you think about, as you think about location. Where are you buying the property? Where are you investing in? Thinking about jumping in 2026. I keep using the word fundamentals because it's so important to understand exactly what you want to do. So that was just that. But I want to talk a little bit about the financial structure because that's where strategic timing really shows up, right? So I told you we're acquiring this for 33 million, but the deal is particularly powerful because we're assuming an existing loan of 3.5%, and that is fixed, right? So again, hearing me say that, it gets me very excited. It's 3.5% and it's fixed. And so if you're thinking about like today, commercial real estate pricing is like about 6%, 6 to 7, but that's having, you know, thinking about that, right? 6 to 7%, but we have debt locked in at 3.5%. It just makes it more competitive, right? And that differential is going to save us a lot, one in debt service, but that's also going to flow directly into cash flow, right? Again, remember I told you to be thinking, is it going to cash flow today? Does the deal work today, right? What that does is it really just gives us cushion, right? If market conditions soften, which can happen because again, something will go wrong, right? So thinking about ways to cushion, your investment even from the beginning. And so, and again, right, it's fixed. So it's not, there's no, like, it's very predictable. It's not going to change. It's not floating debt. But that structure alone really is worth millions in value when we start thinking about really leveraging, making sure that the deal looks good today as opposed to next year, the year after. Again, right, that also provides a lot of, again, downside protection. So you're thinking about like 3.5% fixed gives us cushion. If something happens, we have a soft landing. But those are some of the kind of like advantageous financing that you have to be thinking about, especially as you're thinking about investing in 2026. And so when we underwrote Park at Arlington, we made a conscious decision. The deal has to work today. And that is with current rents, with current conditions. We did not assume massive rent growth. So we didn't say, even with what we think is going to happen with Meta data center, the Rivian EV plant, we didn't bank on it, right? So we assumed for very, very decent market rent growth, but also like we were very conservative with our underwriting in terms of vacancy. So even thinking about like we stress test for higher vacancy. So not where vacancy is today, but like if it goes up by another percent or two, right? What will that do to the deal? Those are the built-in margins that we built in for, anything kind of unexpected. We also have unexpected, capital expenses. There's margin that's built in for that. But those are the ways that we underwrote a little bit more conservative, and making sure that the deal still works today. This is the truth, right? I don't know exactly what's going to happen in the next 3 to 5 years. We don't know how it's going to unfold. We plan, we do our best. We look back and see, what happened in the past to help us kind of think through what will happen in the future. But nothing goes according to plan. So we still underwrite very conservatively and think about all the things that could go wrong, and make sure that we account for that. But again, we didn't even factor in kind of the Rivian upside and Meta. All of that is gravy. We kind of just use what's going to happen today, current rents, current market conditions, and making sure that the deal is still cash flowing. So there's going to be a value add component real quickly. That means that we're going to go in and do renovations to appreciate the value of the property. A lot of that is operational. So we're not gutting units, right? A lot of what we're doing is light value add, but we're not, significantly doing renovations and hoping that we're going to get like $400 in rent. We're not, like rent differential. We're not doing that. We're really just thinking through like blocking and tackling. That's how we're going about it. So we want to improve, property management. We want to enhance a lot of tenant services. We want to upgrade the common area. Think curb appeal, right? You want to, when you walk in, you want to see a lovely place. So those are some of the things that we're going to be doing. And then thinking about like reducing operational expenses, like through, thinking about like better vendors in the area. But in addition to all of that, right, we're still going to do value add. But these are the things when you start talking to, operators and owners and the partners that you're going to partner with, right? You want to make sure that they know how to execute, that they're not, making risky decisions. They're not depending on really market conditions. They're really thinking through, how can I better manage this property? How can I operate it more efficiently over time? And how can I create value that way? That is how they need to be thinking. And that's what makes the deal, that's going to be what will make the deal look better, right? But again, you don't only focus on the upside for the deal to work, right? It has to be, thinking through, how can I create value today on top of an already solid foundation? So what does this translate to an investor, right? Because that's what a lot of our investors want to know, like, what am I going to make in this deal? And again, with the conservative underwriting and where we think kind of the market is going to go in the next 5 to 10 years and the value that it's going to bring to the property, we are, we're projecting that you will make about like 17% annually on the deal. And that looks like about, like 1.8 times what you put into the deal over the hold, right? You'll also be getting quarterly distributions that's going to start year one. So after we close, first quarter of full financials, you're going to start getting your distributions, right? And these projections, they're not, again, based on unrealistic assumptions. They're not best case scenario, right? They're what's happening today with, again, I'm just repeating it because it has to make sense to you, but current rent, current market conditions, kind of like conservative thinking about how rent is going to grow very conservatively. These numbers are based on that today, right? And so the key that you have to think about, right? We don't need to hit any of these major targets, right? So like Rivian doesn't have to come in, and ramp up if they, maybe ramp up and like their whole production ends up taking a year. We don't need that, right? The deal works today. It's cash flowing today, and that's the most important things. But you're giving yourself multiple paths to success, right? So you want to, our goal is to outperform what we say we're going to deliver to you. So all of these other, avenues are ways that that's going to happen. Okay, so I want to bring back the framework. I talked about it a little bit, but those 3 questions that I kind of use, and everybody has theirs, but this is just a really simple way to start even thinking about having a conversation, as to thinking about, is this a good deal? Is this a deal that will work? The first one, again, I said, does it work today? Does it cash flow today? Yes, and it does, with the in-place rents, with the favorable leverage, with the 3.5% interest rate that is fixed, kind of with the market fundamentals, and that's not even factoring kind of Rivian and Meta and all the other things, and the our plan with with value add and thinking through the operational efficiencies. Does it cash flow today? Yes, it does. And the second one was, is there downside protection? So, and again, right, the debt structure really builds in, a lot of cushion when you compare it to today's market rates, right? And again, the experience of the operators is very big because you have to make sure that you're building in margin for error and that's included in a lot of our assumptions. And if you are here and you're thinking, I would love to see those assumptions, I'd love to see those underwritings, reach out to our team. We'd love to send that to you so that you can really understand and see what that looks like. It involves a lot of numbers. So get ready to look at detail in Excel spreadsheets, but it's very worth it for you to really understand. And I think that's something that you should be able to ask from your operator and or your partners, and they'll be able to send that to you. And then the third one, right? This one is a little kind of softer, which is, does it align with life goals? And the answer is yes, right? This deal is completely passive. You're going to get quarterly distributions. I think it's important for you to learn and to understand what's going on with your investment, right? But it's truly passive, right? You make the investment, we make all the decisions, and making sure that it aligns with your goals. And then you stay focused on, building your career, building ownership outside of it. So that's what that looks like, right? So this does check all the three boxes. And it's only after really looking at it through these lens that I'm able to say, yes, I want to invest. I want to do this. This is exactly what I want to, I want to put my money behind. But I really, real quickly, as we start wrapping up, right? I want to be clear about, kind of thinking about 2026 and opportunities like this and who this is for and who this isn't for, right? This is for you if you're thinking, I'm ready to invest in real estate. This is the right time. I've been sitting on the sidelines. And now I know really how to, think through vetting a deal. I now understand, just the value. I now understand what value really means. So this is for you, again, if you value consistency over speculation. This is for you if you want passive income. And so if you want passive cash flow in real estate, then opportunities like this are what you need to be looking into. This is also for you if you're thinking long term. So if you're thinking 5 to 10 years, this are the types of opportunities that you should be thinking about. And if if you really understand kind of thinking through wealth and ownership, right, and not just thinking through high income, then opportunities like this is where you should be thinking about investing, right? If you're comfortable with, or you want to get comfortable with understanding, the real estate fundamentals, market cycles, all of that is very important. And opportunities like this are right for you. Now, if you're looking to like quickly flip, a property, or then something like this is not for you. So if you want to get rich quick, again, not for you. If you're uncomfortable with kind of real estate and understanding the asset classes, it's also not for you. If you're looking for liquidity kind of in the next 6 to 12 months, these opportunities are not for you, because this is really more kind of long term. Again, I told you it's 5 to 10 years. And so those are, if any of those kind of are things that you're thinking about, then this opportunity is not for you. But when you think about, long-term, passive, cash flowing real estate, thinking about ownership from that standpoint, then opportunities like this are for you because they align with how you're thinking and what you're thinking. So my team is going to put up a link again. So this is kind of where we are right now, right? I've walked you through why 2026 is this strategic window. A lot of us have been sitting down, sitting on the sidelines, thinking about it. I think it's very important that I shared my journey with, like, kind of going from being dependent on my W-2 to ownership. And then I wanted to really spend the time to show you an opportunity like Park at Arlington and how it's a specific example as to how we're applying the principles that we're thinking about today. So the next step is very simple, right? If this resonates with you, review the investment package, and I'll make sure that you get access to everything. So the underwriting, the offering memorandum, so like the deal deck, the financial projections. If you want any additional due diligence material that we went through, I'd love to share that with you. But more than that, I want you to ask questions, right? Challenge the assumptions, make sure that you understand, what you're investing in. That's very important. You should be able to ask me any question. And I should have clarity and transparency on what I'm thinking, how I'm thinking, the plans, and where I'm going, right? I think that's very important. So, and after that, right, decide if this kind of fits your, strategy and aligns with your goals, with where you want to be in the next 5 to 10 years. So my goal today was not to convince you to invest, right? I wanted to just really give you clarity and insight so that you can make the right decision that serves your life. And so you don't just react to the market noise, because everyone is like, this, do it now, do it now. But I really wanted to help you understand why you should do it now. And I get this question asked a lot, right? And I just wanted to mention it here. People are like, okay, well, how do I invest, right? You can simply invest with cash, and all the information will be on the portal. That's the link that is on the screen. So just click on the portal, create an account, and then we'll be able to help you through the rest. Or, you can use an old 401k, or if you have an individual retirement account, you can convert that to a self-directed IRA account, and then you can invest through that. So we have a custodian that can walk you through the entire process. So just again, reach out to our team, and we'll be able to get you going with that. But I want you to know that you have options, and that's really why we have this conversation. So I want to leave you with one final thought, and thank you for sticking around. Some of the most kind of expansive chapters of our lives, they don't begin when everything feels obvious and everything feels easy and everything feels ready, right? That's not when it happens. It happens when we make a decision and we want to move kind of thoughtfully, while others are still waiting for a little bit more certainty. And so I would use the example here is kind of when we shift from just earning to start owning assets. What that looks like, I gave you an example, right? It's when you stop kind of playing defense, and you start really building, you start thinking about how can I build something towards outliving kind of the daily grind, the thing that I'm doing every single day. And so again, right, I'll leave you with this. 2026 is not going to feel like this like boom year where this is going to happen. It might not even feel really exciting, right? The headlines are not going to be screaming that you should invest. But for the people who really position themselves now, discipline, clarity, fundamentals, understanding, learning, right alignment, right? This could really be the year that changes everything. And it's not because the market is like handing you a gift, right? But it's because you are making a decision to act while others are still waiting. And I think that's the most important that I want to leave you with today, is that you have the right tools, that you learn, but at the end of the day, that you make a decision, and that you decide that you're going to make a decision and you're going to do it today. So I want to say thank you so much for your time. Please feel free to put questions in the chat. If you have any questions, don't hold back. If you want to kind of ask me questions about the market thesis, about the investment process, about tax implications, kind of my personal experience, any and everything. I'd love to answer any questions and kind of help you think through what's best for you. I would love to answer any of them. So toss the questions in the chat if there are any, or maybe I was very clear. Hi. Thank you. Wonderful. Thanks, everyone. Yes. Well, we can get you access to the slides, definitely. Okay. Well, I just want to say thank you, everyone. Thank you so much for your time, and thank you for sticking around with us. Again, feel free to click on the link, and then we'll definitely be in touch. Have a wonderful evening.